Hey guys, it's Jack. Today we're going to be looking at the top 5 mistakes you need to avoid in the stock market so you don't end up losing money. Whether it's pure beginners or people that have been investing for some time, I've seen countless people make the same mistakes day in and day out. The thing is that you might be already making these mistakes, but hopefully by watching this video you can review your own portfolio and investing style and save yourself some money and hassle in the long term. Just want to say that I'm not a financial advisor and this is just my opinion. The first mistake is letting somebody else's investment strategy influence yours. Your investment goals are individual to you. People you see on YouTube have different goals. Your goal might be to buy a house in the next 2-3 years. Somebody else's investment goal might be to grow their portfolio as large as possible using riskier growth stocks. Something that might be suitable for you at that time may be more stable dividend stocks, while they're investing in more riskier growth companies. If you know you're going to liquidate your portfolio in the next 2-3 years because you need that money for the house deposit, you're not going to have the long 10 to 15 year period to see those growth stocks play out, which is why it might not be even worth for you to even look at growth stocks, or it might be worth for you to resize the allocation in your portfolio so the impact is less overall. Think about it this way: imagine you put all your money into growth plays and the market just takes a hit, it just crashes and it takes 10 years to recover. When you're going to have to buy a house in the next 2-3 years according to your initial plan, you're either going to do one of two things. Either you're going to liquidate your holdings, liquidate your stock portfolio at a loss because the market crashed and you need that money now, or you're going to have to wait for this price to recover, which may take 5-10 years or even longer. Now, you not buying your house at the start like you planned is a large time or opportunity cost, because you're not only having to pay more rent where you would have had to pay a mortgage, you're also missing out on the leverage appreciation you get with a house. When I invest in growth stocks, I know that I'm not going to be touching these stocks for the next 10 years at a minimum, because in reality those companies could die, they're very young, anything could happen to them. I only allocate a very small part of my portfolio into growth plays, so they don't affect any of my house buying decisions or anything in my life for that matter. So whenever you're watching somebody on YouTube or whatever, have your own investing goal in mind. Only take out the bits of knowledge that they're giving that are applicable to yourself, and don't just go blindly copying someone else. Now this really links into my next point, which is taking too much risk. And this is where I want you to go look at your portfolio and see how diversified you really are. Even if you have invested in a large amount of stocks, it does not mean you are fully diversified. You might have 20 different companies in your portfolio, but if those 20 companies are in the tech sector and the tech sector takes a hit, you're going down with it. Similarly, if you have a lot of banking and financial shares, if interest rate changes aren't in the favor of the banks, your portfolio is going to be taking a hit. You really need to look at the underlying sectors you hold. I never recommend holding just one sector, especially if you're going down the route of individual stocks. If you're more into ETF investing and just like to invest in the market as a whole, the next mistake you need to avoid is timing the market. What this means is that, let's say you are a regular investor in the S&P 500 fund and there is some news that suggests that the market is going to crash at some point, maybe next month. Now, if you wanted to time the market, what you would do in this case is take your money out, wait for the crash, and then invest back in buying more shares for the same money. Now, although everybody would like to think this strategy would work, and it may work one time, but it won't work every single time because we don't have a crystal ball to predict what's really going to happen. What if the market shoots up 40% before it does crash 10%? You would have missed out on all those gains. The big bank Merrill Lynch did a whole study on this, taking into account the return from the S&P 500 from 1989 to 2018 with $1,000 invested. They took 3 scenarios into account. The first scenario was the buy and hold scenario. You're literally buying the stock and you're just holding it. The second strategy was the investor who tries to time the market and misses out on the top 10 performing months of that time. The third scenario is the investor who tries to time the market but misses out on the top 20 best performing months in the same time period. The results, guys, were really shocking. With the investor who missed out on the top 20 best months, they only got a return of 223%. In other words, they got $3,300 for their $1,000 investment. The investor who missed out on the top 10 performing months ended up with just $7,000 of their $1,000 investment. Now, the buy and hold strategy grew the investment from $1,000 to $17,000. That's a 1,600% gain, which is why I personally avoid timing the market. It goes back to the old saying, guys, time in the market instead of timing the market. The next mistake is for you dividend investors out there, and that is investing in dividend trap companies. In the current environment where the banks aren't giving any interest at all really, a lot of people are looking for some dividend stocks to park their money so they can get some quarterly payments for it. Now, dividend trap companies are stocks that offer a good dividend yield, but they cannot afford to give that out. These are companies that are purely designed to look like they're good dividend payers, but behind the scenes is something else going on. But with that in mind, it's very easy to have a quick initial check to make sure your stock is not a bad dividend company, a bad dividend money pit. I mean, there are really two aspects to this. The first is, can the company really afford to give out its dividends? The second is, how safe is that dividend? How sustainable is it? And to do the check, what you want to do is take your stock, go to yahoofinance.com, search it up, and then under the stats tab, look for dividend payout ratio. It's literally one number, one percentage that will give you a lot of information about a company's dividend. What the percentage means is how much the company is giving out to investors like you in relation to the company's net income. If it is over 50%, then you know the company is giving out more than half of its earnings as dividends. And that's considered relatively high, but it could work for some companies. Anything over 75% is really high, and anything over 95 to maybe over 100% is extremely high. That means it's giving more cash, more dividends to its investors than the company's actually earning, and it's bound to end at some point. A good example of this is Marathon Petroleum. You might have seen other companies like this, but this particular company's dividend payout ratio is 110%. Now, not only does this mean that they're giving out more money than they're making, but they're also taking on loans, debt to give you that money. Otherwise, where else would it be coming from? On the other hand, Apple has a good dividend payout ratio at just 18%, so you know the dividend is relatively safe and sustainable. Now, the next point really touches base on sustainability. I would not recommend anybody doing this with any sort of investment strategy, and that is investing with leverage of any kind. Investing with leverage is investing with borrowed money. Now, I'm not only talking about those CFD accounts you get on Trading 212, but also those 3x shares. If you invest with leverage, you are disadvantaged by either time or interest or any additional management fees you will pay because you're trading with leverage. Let's say you're trading Tesla with leverage on a CFD account and Tesla goes down for 10 minutes due to some random event. If your account is in the minus by a certain percentage during that time, the broker has the opportunity to then close your positions for you because you're investing with their money as well. So in a matter of minutes, you could wipe out your entire account. It could go to zero before Tesla comes back and recovers. Now, these random event guys happen all the time in the stock market. You know, we saw China's chip shortage impacting stocks like NIO and other tech companies who need chips for their business. The thing you have to combat these short-term random events is time, and you won't have time to ride out these events when you're trading with leverage. I really hope you found this video useful. Please hit the like button if you did, subscribe if you really want to see more videos like this, and I'll see you in the next video. Thank you so much for watching.